Welcome, Stock Talk listeners. Today we're diving straight into Starbucks, specifically their Q2 fiscal year 2025 results. They just came out April 29th.
That's right, fresh off the press.
And we know you want the key takeaways quickly and thoroughly. So that's what we're aiming for here. We're pulling from the Starbucks stock analysis materials. And really, the big theme seems to be this back to Starbucks strategy.
Yeah, that's definitely central to understanding these numbers.
Our mission today: extract the most important nuggets about their performance and, where they're headed strategically.
Okay, let's get right to it then. Consolidated net revenues.
Yeah.
They were up 2% year over year, came in at $8.8 billion,
Mhm.
or 3% if you look at constant currency, so growth on the surface.
Okay, 3% constant currency growth, but...
But global comparable store sales actually dipped by 1%.
Okay, so existing stores, sales down slightly.
Exactly. And what's really interesting is why. It was driven by a 2% decrease in transactions.
Fewer people buying things.
Fewer individual purchases globally, yeah. Even though overall revenue ticked up slightly.
That's quite a dynamic. Fewer customers, but somehow slightly higher revenue globally? Maybe higher prices or different product mix.
Could be. But the profitability side, well, that tells a tougher story.
Right. Talk about that.
Their GAAP operating margin.
Sorry.
It took a big hit. Contracted 590 basis points.
Wow, 5.9 percentage points. Down to...
Just 6.9%.
Roof. And earnings per share.
Also down significantly.
Huh.
GAAP EPS decreased by 50%, half year over year,
Yeah.
landed at $0.34.
52%.
Yep. And the non-GAAP EPS, that was down 40% to $0.41. So big pressure on the bottom line.
But they are still opening stores, right?
They are. Global store count kept growing, up 4.7% year over year. They're at 40,789 stores now.
So the picture is revenue up a bit, helped by new stores, but comparable sales are down, driven by fewer visits, and profits took a major dive.
That sums it up pretty well. Expansion is happening, but the performance and profitability of, let's say, the core business face real headwinds this quarter.
Okay, let's break that down regionally. North America, their biggest market. How did that look?
Similar trends, maybe even a bit more pronounced. Comparable store sales, they were down 1%.
And the U.S. specifically.
Down 2% in the U.S.
And transactions.
That's the key number. Transactions in North America dropped 4%.
4% fewer visits. Wow. Was there any offset?
Partially. The average ticket, how much people spent per visit, was actually up 3%.
So fewer people are coming, but the ones who do come are spending a bit more.
Exactly. But clearly not enough to make up for that drop in traffic.
And the operating margin in North America must have taken a hit too.
A big one. Contracted by 640 basis points. That's 6.4 percentage points, down to 11.6%.
That 4% transaction drop in the U.S., that feels like a significant signal, doesn't it?
It's definitely a red flag. For a business built on frequency and traffic, a 4% decline is worrying. Raises questions about competition, consumer habits, maybe pricing.
Lots to unpack there. Okay, let's pivot to international. How do things look outside North America?
A bit different, actually. International comparable store sales increased by 2%.
Oh, okay. Positive comps internationally. What drove that?
Transactions, they were up 3% internationally.
So more people visiting stores outside North America. That's interesting.
It is, but even with those positive comps, the operating margin internationally still contracted.
Really? By how much?
By 170 basis points, so 1.7 percentage points. It also landed at 11.6%, same as North America, funnily enough.
So sales are growing internationally, driven by traffic, but profits are still under pressure. Why is that?
Well, the analysis mentions increased promotional activity in the international segment. So maybe driving sales, but at a cost to margin.
Right, discounts and offers eating into profit. Makes sense. And China, always a key market to watch. How did they do?
China's the big turnaround story this quarter, relatively speaking. Comparable store sales were flat, 0% change.
Flat doesn't sound amazing, but context is key here, right?
Exactly. Last year, same quarter, they were down 11%. So flat is a huge improvement from minus 11.
Okay, that is significant stabilization. What about transactions and ticket price in China?
Transactions were actually up 4%, so more customer visits.
Good sign.
But the average ticket was down 4%, so people visited more but spent less each time, canceling each other out for the flat comp.
Interesting. But net revenue in China?
That still grew by 5%, mostly driven by store growth. They added 9% more stores there year over year.
How many stores is that now in China?
They just crossed 7,750. 7,758 to be exact.
Wow. So China's stabilizing, traffic is returning, even if spend per visit is down. And they're still expanding aggressively there.
Yeah, that's a much more positive narrative than North America this quarter. It suggests maybe some elements of this new strategy are getting traction there, or perhaps the market dynamics are just different.
Okay, so we see these regional differences, but overall profitability is down sharply. What were the main drags on profit across the board?
The report highlights a few key things.
Mhm.
First, increased labor investments. That's tied directly to the Back to Starbucks strategy, focusing on their store partners.
Investing in people costs more, short term at least. Makes sense. What else?
Second, deleverage, especially from those negative comparable sales in North America.
Can you explain deleverage quickly?
Sure. Think of fixed costs, rent, manager salaries, things like that. When sales go down at existing stores, those fixed costs become a larger percentage of the revenue you're making, so profit margins shrink.
Got it. Lower sales, same fixed costs equals lower margins.
Precisely. Third, they had restructuring costs, about $116 million. This is related to simplifying their global support structure, corporate overhead,
A one-off cost for reorganization?
supposedly. And finally, just generally higher store operating expenses. Those were up 12.1% year over year. Plus, like we mentioned, more promotions internationally and also higher product costs, impacting their channel development segment, stuff they sell through grocery stores via the Global Coffee Alliance.
So a combination of strategic investments, restructuring charges, weaker sales performance, hurting efficiency, and just general cost inflation.
Yeah, it paints a picture of a company investing heavily, that labor piece, the restructuring, while also fighting against weaker demand in its main market and rising operational costs.
Which brings us right back to the back to Starbucks strategy.
Mhm.
You mentioned the labor investment. What else is part of this plan? It was launched early this year under the new CEO, Brian Niccol, right?
That's right. It seems quite comprehensive. Key parts include, yes, the investment in partners, but also a renewed focus on coffee quality, kind of getting back to basics.
The core product.
Exactly. Also simplifying the menu and store operations, trying to make things more efficient, maybe faster for customers and easier for staff.
Okay.
Then there's the organizational restructuring we just talked about, reducing support roles. Also, trying to improve the value proposition for customers. Maybe not just price, but what you get for your money.
Value perception is key.
And finally, enhancing the digital side to Travelworks. Starbucks Rewards, mobile ordering, making that experience better.
It sounds like they're touching almost every part of the business.
It really does. It's not just a tweak here or there. And the CEO, Niccol, sounded quite optimistic in the commentary. He mentioned seeing more opportunity than I imagined and pointed to those improving transaction trends as early positive signs.
So management believes the plan is working, or starting to, even if the headline profit numbers look rough right now.
That seems to be the message. Investing now for future gain and seeing some green shoots in customer behavior, particularly internationally, and with those transaction trends potentially bottoming out or improving.
Okay, let's look at their financial health overall. How's the balance sheet and cash flow?
Well, they ended the quarter with $2.7 billion in cash and equivalents. That's down from the end of the last fiscal year.
Less cash on hand, debt,
Total debt held relatively steady, around $15.6 billion.
and cash flow from operations.
For the year to date, so the first half of their fiscal year, operating cash flow was $2.4 billion, which is down compared to last year, kind of mirroring the lower earnings.
Okay. Capital expenditures, are they still investing in stores and tech?
Yeah, CapEx year to date was $1.3 billion, slightly up from the prior year. So investment continues.
And what about returning cash to shareholders? Dividends? Buybacks?
This is interesting. They actually increased their quarterly dividend by 7%, up to $0.61 per share.
Raising the dividend despite the profit drop?
Yes. And they highlighted maintaining 60 straight quarters of dividend payments. It's clearly a priority.
But share buybacks?
None in the first half of this fiscal year. Zero. Compared to $1.3 billion they spent on buybacks in the same period last year.
So prioritizing the dividend, continuing CapEx, but pausing buybacks. Seems like they're conserving some cash, maybe for those strategic investments.
That would be a logical interpretation. Protect the dividend, fund the turnaround plan and store growth, and pause buybacks for now.
Speaking of store growth, you mentioned the total number. How many new stores did they actually open in Q2?
They opened 213 net new stores in the quarter.
Okay, bringing the total to that nearly 41,000 mark.
Right, 40,789. But it is worth noting that the pace of net new openings has slowed down compared to the previous year.
Slower growth rate.
Yeah.
And are US and China still the main focus for new stores?
Absolutely. Those two markets combined still make up 61% of their entire global portfolio.
But maybe the slower overall pace suggests, like you said, a bit more focus on getting the existing stores right under this new strategy.
Could be. Or perhaps just being more selective, though, as we noted, China's store growth rate itself was still quite high at 9%, suggesting continued emphasis there.
Okay, so pulling this all together, based on this Q2 report, what would you say are the key opportunities for Starbucks going forward?
Well, number one is definitely seeing if this back to Starbucks strategy gains more traction. Those improving transaction trends the CEO mentioned are key. If they can turn those positive, especially in North America, that's huge.
Right. What else?
The stabilization in China is a big opportunity. If they can build on that flat comp and returning traffic, that market remains a massive growth engine.
Makes sense.
Also, potential benefits from the simplification efforts, if they can genuinely make operations more efficient. Enhanced digital engagement through rewards and mobile apps is always an opportunity to drive loyalty and frequency.
And maybe margins eventually recover.
That's the hope, right?
Yeah.
If the investments pay off and sales improve, margins could recover. And continued international expansion outside of China still presents opportunities.
Okay, lots of potential positives if the strategy works. But what about the flip side? What are the major risks they're facing right now?
The biggest immediate risk is clearly the continued pressure on North American comparable sales. They have to get traffic growing again in the U.S.
That seems critical.
Then there's the ongoing margin compression itself. Those investments are costly, and if sales don't respond quickly enough, margins could stay squeezed for a while.
Execution risk too, right? Big strategy changes, restructuring.
Absolutely. Executing that kind of organizational change smoothly is always a challenge. Plus, you have increasing competition, everyone's selling coffee now, and broader economic factors, potential consumer spending headwinds if the economy slows, and of course, the usual geopolitical and economic risks in their international markets. It's a complex environment.
No shortage of challenges, though.
Definitely not. The strategy seems aimed at addressing many of these, but success isn't guaranteed, especially with those North American trends.
So wrapping this up, it sounds like Starbucks is really in a major transition phase. This Q2 report shows the back to Starbucks strategy is underway, maybe showing some early promise, especially internationally and with those transaction trends.
But it's coming at a significant near-term cost to profitability.
Yeah, those strategic investments, combined with the very real headwinds in North America, are hitting the bottom line hard right now.
It really highlights that classic tension, doesn't it? Investing for the long term versus delivering short-term results. They're clearly making choices that prioritize the future, hoping it leads to more sustainable growth down the road. But shareholders are feeling the pinch today.
Yet they did raise the dividend. That's a signal of confidence, perhaps, or at least a commitment to shareholder returns despite the current pain.
It's a notable signal, yes. Maintaining that payout seems very important to them.
So, for you, our listeners, as you watch Starbucks, what should you be focusing on in the next few quarters? What are the most critical signs to look for to see if this turnaround is actually taking hold?
I'd say watch those transaction numbers like a hawk, especially in the U.S. Are they improving? Watch the comparable store sales figures globally and regionally, and keep an eye on operating margins. Are they starting to stabilize or even recover as some of these investments hopefully yield results?
And maybe thinking bigger picture. What does Starbucks' current situation tell us about the challenges even huge, established global brands face today? You know, trying to stay relevant, efficient, and profitable in such a dynamic consumer world.
It's a great question. It shows that even iconic brands can't stand still. They need to constantly adapt to changing tastes, competitive pressures, and operational complexities. It's a continuous balancing act.
Definitely something to ponder as you continue your own analysis. Thanks for taking this deep dive with us today.